You're watching the Blockchain Interviews, hosted by Dan Weiskopf. Each episode features interviews with leading industry experts so that viewers can have a deeper understanding of today's quickly evolving blockchain marketplace.
Today, I'm joined by Mike Cagney, Executive Chairman of Figure, a truly innovative fintech company focused on the blockchain. Mike was also co-founder of SoFi. In this interview, I hope to really dig deep into how Mike has identified opportunities to disrupt and, frankly, to innovate as well. Mike, thanks again for joining us today. Appreciate it.
No, thanks for having me. Just one point of clarification. I'm still the CEO of Figure too. So you give me a title upgrade there, but CEO
I'm
and
sorry.
chairperson.
I
That's
apologize.
All right.
Very
That's
cool.
all right.
So you're also the guy who executes, to your point.
Indeed.
Yeah. So thank you. So let's set the table here. Figure is so immersed in the blockchain, with just really a small mission of transforming trillions of dollars in the financial services industry. Tell us your overview of Figure so we understand where we're going on this interview.
Sure. So we think about blockchain as having two really valuable aspects that lend itself to disintermediate a lot of the intermediation within the financial ecosystem. So those two things are the ability to displace trust with truth. So you have certainty as to what it is you're transacting to, and the ability to bilaterally transact without any intermediation, without counterparty risk or settlement risk. And when you bring these things together, you create marketplaces where you become completely agnostic who the counterparty is to that marketplace, because you're not requiring trust into that counterparty. And so if you think about the broad ecosystem, you think about lending and $13 trillion of lending production, an enormous amount of cost and inefficiency is tied up in that intermediation process, and to the tune of hundreds of basis points. If you think about payments, and in particular interchange and the market cap that Visa, MasterCard, and PayPal have dominating that vertical, they're purely intermediaries in that transaction process. And blockchain provides a vehicle or a path to disintermediate that out. And if you go to exchanges, obviously an exchange by definition is an intermediated function, right? In terms of sitting in between a buyer and seller and facilitating a transaction. And as you cut across public and private exchanges, you've got well over $1 trillion of market cap. And so we think we're in this very, very interesting and exciting time where you actually have a viable path, and it's not just a theoretical construct. And in the case of Figure, we've de-risked a lot of this, and I'll talk more about that in a moment. But you have a viable path on how you're going to take trillions of market caps out of these traditional intermediary incumbents, and that's going to benefit or accrue into the blockchain ecosystem and to the broader ecosystem as well. And it's doing that in the form of gas fees that you're paying on blockchain in lieu of what you've been paying for intermediate transactions before. And so, from our standpoint, we started this in 2018, extremely high level of excitement and enthusiasm, but really three headwinds that we had to navigate through. One being that traditionally everything within the blockchain, especially within the DeFi construct, was Ethereum or Ethereum derivative. Obviously, proof of work Ethereum is a relatively expensive and slow way to transact, and that lends itself to some problems within the blockchain construct. But also the architecture of Ethereum, and in particular, if I do something like put a loan on Ethereum, what I'm putting on is the enforceable contract, and the issue is when that enforceable contract, let's say in the context of Ethereum 2.0 distributed stakeholder blockchain, that enforceable contract's going out to each of the validators, the US courts would say, well, that's no longer a single enforceable contract. And so you have issues in terms of data ownership around the construct of how the blockchains have been built. And so we ended up building a chain called Provenance using the Cosmos SDK and the Tendermint consensus module. It's public, it's open source, it's decentralized. We have a large amount of the gas fee, but we can't vote it, so we don't have any outsized governance control. But that gas fee gives us a huge incentive to drive adoption onto the blockchain. But we built it in a way to address these three things. So speed, and cost, obviously, but also control of data. And that data control is important, both from a PI and record keeping standpoint, but also from an enforceability of contract standpoint. The second challenge we had off of this was there was no real way to represent fiat on chain outside of the traditional stable coins, USDC, USDT, some of that ecosystem. And the challenge is, as we all know within the crypto universe, is there isn't enough stablecoin within the blockchains to support even just crypto activity, let alone moving mortgages or payments or exchanges entirely onto chain. And so we really needed to find a way to get banks to lean in and start providing fiat representation on chain. And so what we did originally with Provenance was what Circle and Tether did. You'd wire money to Figure and we'd fund your digital wallet. You'd transact bilaterally without counterparty risk, but you're taking Figure risk. And we had to pull that out of the equation. And so about 4 weeks ago, we did a transaction, which was kind of a seminal first across two different verticals. So we had 72 Figure employees sell $8 million of Figure stock in a limit order book secondary market. And the Figure stock is entirely digital. There are no paper certs. It's we use Provenance as a cap table. About 200 companies are using Provenance as a cap table right now. But effectively, they were able to log on, put their stock up for offer, and then we had two institutional investors come in and bid to that stock and transact with those employees and settle real time T-instant. And this was a milestone transaction on two fronts, and that it was the first time there was a securities transaction where those securities were custodied on chain, settled through a marketplace. And we did that through our broker-dealer ATS exemption that we've gotten from FINRA and the SEC. But more interestingly on that transaction, the buyers bought USDF, so effectively a digital fiat marker directly from New York Community Bank. So they didn't intermediate to Figure. New York Community Bank created an insured deposit behind that USDF coin and effectively funded those buyers. Those buyers transacted with the sellers. The sellers then went to the bank to redeem back for fiat or to hold the USDF. And this is the beginning of what is now called the USDF consortium. So there's a group of banks that are setting the standards, the bylaws, the structure of how they're creating a reciprocal coin, USDF, to facilitate transactions on the chain. And this does a couple of really important things, which is one, it basically provides a conduit for unlimited fiat on blockchain. Right, you no longer have the constraints or limitations of what goes on, subject to the amount of credit risk that you want to take from one of the traditional stablecoin issuers. You're going to have an enormous amount of fiat available that the banks can deliver anytime that it's needed. That obviously opens up the marketplace applications for blockchain, but it also creates a whole level of second order benefit, payments and payment settlement, for example. So being able to move USDF between any two counterparties completely disintermediates out interchange, wire, ACH, cross-border SWIFT, right? You now have a mechanism to move value real time across a set of participating banks that have reciprocity of that token. You can build a whole set of applications around programmable money, so payable, receivable marketplaces and supply chain finance marketplaces, where you can manage the invoicing encumbrance such that when USDF goes to relieve the invoice, it goes to the appropriate holder or the right encumbrance of the invoice. So there's just really cool stuff that's going to come out of this, and we think it's going to be a huge application. But that fiat piece was a struggle that we had for years, right? I mean, literally, we just solved it 4 weeks ago. And we're now at a point where it's taking off rapidly. There's a ton of banks that are leaning into this consortium, and to be clear, we're not part of the consortium. We can't be. You have to be a bank to be part of it. So effectively, what we did is facilitated the technology, the integration into the ledger systems, so that banks can run this. But effectively, are not center stage on it. The banks are. And the third application or the third issue that we had starting off was everybody liked blockchain back in 2018 and 19 and 20, 21, 22, but none of the banks want to be first movers on it. And so it was, well, this is really cool. We'll wait and see. And, we realized that early on and said, okay, we'll be a first mover. We'll create a series of operating businesses to execute on chain. And these operating businesses are going to get the first order benefit of the fact that they're early movers are going to get some economic rent for that. But ultimately, what they're really doing is de-risking the blockchain and crowding an adoption. Because our view is what we own in hash which is the underlying utility token on provenance, that's going to be worth more than any of the operating businesses we're ever going to be able to build on a standalone basis. And if you look at hash today, it's at about a $12.8 billion market cap, and we own 70% of it. And we think that's nascent in terms of where it goes. And we've been very particular with hash where the Provenance Foundation hasn't done the same kind of validator awards and incentive structure that traditional chains have done. Basically, if you're using Provenance, you're using it because there's an economic reason to do it. And there's a whole bunch of people using it. We'll talk about that today for different purposes. But we were first, and it kind of created some challenges with the traditional venture community because they look at Figure and they're like, well, you're a lending business. And we're like, well, no, we're not. I mean, yeah, we have a lending business that's doing $1 billion of revenue this year, about 250 million of profit, but that's not the point of Figure. They say, oh, well, you're a payments business, and well, we're there to facilitate payments and drive USDF adoption. Well, you're a marketplace business. Well, we are, because again, we're de-risking that use case and driving exchange applications or marketplace applications. But what we really are at the end of the day is a holder of a utility token on a blockchain that we think is going to ultimately win DeFi. And that's really what the whole point is.
It reminds me of the movie You've Got Mail, right? Where you're an internet company. Well, yeah, you're a book company like Amazon, and in the end, you're facilitating change, and right. That's the excitement here. How you're doing it, Provenance is really at the core of it all, and I get where you're going on that. So, but you've come through a path here. How did you get into the lending side? You had to make an acquisition. Is that correct?
Well, we started off organically. So we, obviously the bulk of the team that we have built SoFi originally. And so we knew the lending space extremely well. And so we started organically and, outside of mortgage. And what we did recently is we did a transaction with Homebridge, where we basically brought Homebridge into the Figure fold. And the reason we did that was it was going to take us a while to build critical mass organically through our own mortgage business. It would take years to be able to build up to where Homebridge was in terms of production and the organization infrastructure that they have. And we felt, again, there were kind of two drivers for this transaction, which was one, we felt that we could go into a mortgage company and turn it into a fintech. And so outside of the context of blockchain, just really around technology. Leveraging deep analytical contextual outreach and cross-sell to drive super high lifetime value off of low acquisition cost, customer channels. But the other and more fundamental motivation was we have an architecture for how we see the evolution of the lending ecosystem. And obviously within the lending ecosystem, mortgage is the dominant asset class. $13 trillion of loans out there right now. Mortgage is $11 trillion of that. And so we had to be able to address that ecosystem. And so we built out a structure from point of sale to loan origination to custody and administration to servicing to marketplace to support any type of lending product. And what we wanted to do was drive a consortium effort into that lending ecosystem. And the challenge is if we were purely a software provider, a technology provider, trying to get the mortgage companies to line up and participate and lean in on this would have been, the analogous herding cats. It just wouldn't have happened. And so what we did is we said, well, look, we're going to buy a relatively large mortgage originator, and we're a top 15 originator at this point. And we're going to push our volume through, and we're going to get the economic benefit of this. And we're going to let anyone else who wants to do it with us. But the point of that is, if you don't want to step in, I've got 30 billion of production at least going through there in the next 12 months. If you do want to step in, you're going to get the same upside that I'm getting. And we think what it looks like right now is we'll build enough of a critical mass of consortium that, it'll be upwards of $200 to $300 to $400 billion of production that'll go through this ecosystem in the next 12 months. And, that's obviously hugely accretive for gas fees on provenance, but it's also really setting the guideposts for what lending is going to look like on chain. And we've done $5, $6, $7 billion of transactions on chain right now through traditional lending. we were the first to originate, unsecured consumer loans and mortgages on chain. We were the first to finance them on a warehouse and securitize them. And we run a relatively deep marketplace right now for primary and secondary loan trading and participation. But this is taking it to a whole new level in terms of scale. And we think this is going to crowd in a lot of the ecosystem, because the economics, the first transaction that we did, we demonstrated about 117 basis points of cost savings from point of origination through deal execution using blockchain. And we think, there's been transactions behind us, not done by us, but done by others, where they've been upwards of 125 to 130 basis points. So there's a really strong, compelling economic reason to lean in and leverage the tech.
The whole premise of our investment philosophy is to focus in on the picks and axes. But what you've done is dig even deeper. And at the end of the day, on the lending side, right, you've kind of focused in on the community bank side. And candidly, to some degree, you may be a hero in that area, because it seems like an area that is shrinking. I mean, I think there were something like 8,300 community banks going back to 2000, and now there's just like 4,500. And the number that are applying is even shrinking more, right? Like 27 have been filed for the last 10 years. How did you come up with that as a strategy?
Yeah, so it's a combination of factors. I think one is that we have a challenge around the money center banks, because they, the big four all want to do their own blockchain. They want to own their own technology. You've got JP Coin and Wells Fargo is trying to do a coin, and et cetera. And but they're not really thinking about it in an open architecture, open loop ecosystem. They're thinking about it in closed loop, where I for one have never figured out closed loop blockchain, because a closed loop, you could run a database and have a much easier life. Blockchain is really specific to when you're in an open loop construct, and you need the certainty of an asset and the bilateral transaction ability. But what happened was we had a lot of regional banks coming to us, and we ended up sort of serendipitously taking an investor, Jam FinTop, in the last round. And they have an incredible ecosystem of bank LPs. And they leaned in and said, look, these bank LPs, they all want to talk to you and talk about what you're doing. And that's how USDF started, right? NYCB was a relationship off that construct, and we said, hey, how would you like to do this? And this was a bank that hasn't invested in technology in 30 years, and all of a sudden is at the forefront of tech, doing stable, digital marker on blockchain. And so what we've done with the regional banks is we basically said, look, whatever technology you want from Figure, we'll give you. So if you want to do loan origination on chain, we'll give you the POS LOS infrastructure to do that. If you want to do USDF on chain, we'll give you the integration into Fiserv or FIS or Jack Henry or whatever your ledger system is to do that. And a whole series of technology that we think is best in class, that's actually stronger than what's in the money center banks right now, where we're effectively contributing that into these regionals. And so you're right, it creates this very interesting dynamic where all of a sudden this regional that's been viewed as technology backwards now has better technology than JPM. And that's kind of the point of what we're doing. And ultimately, JPM and Wells and B of A, they'll come in and leverage this tech. Because we think it's going to be ubiquitous, but the path of least resistance was. I always say when you have to convince someone or sell someone on blockchain, you're in a losing argument, right? You want to have them come in and say, all right, I want what you want, or I want to do what you've done. How do I do that? Versus like, convince me blockchain's a good thing. And there's not enough hours in the day to deal with the people who want blockchain and want to leverage the technology. So that's what we focused on. But there's a huge audience among these regional banks, especially as they're going through generational shifts in terms of management and leadership teams, where they recognize it's a do or die circumstance. And USDF, I think, is a great example where we've said, look, central bank digital currency or JPM coin are basically the death of your business model. And if you don't get out in front of this with a way to represent digital marker across regionals, it's unclear what your role in a banking ecosystem is on a go forward basis. And people could disagree with that, but we had a very strong view that's the case, and that's created a lot of enthusiasm around the technology. And the fact that it's live, it's in production, they're seeing the benefit. The fact that we're standing up, point of sale and loan origination infrastructure where banks that haven't had great technology now have cutting edge tech. They can do the same thing we do, originate a HELOC in 5 minutes, originate a personal loan in 2 minutes, right? Whatever the time frame is. It's a huge win for them.
Yeah. So doing a HELOC in 5 minutes versus a month.
45 days. 45 days is the average right now.
Yeah. I mean, this is a great example of real utility, right? And it's far more than price. It's changing the world. So we're super excited about it. So along those same lines, so we talked about the lending side. Let's talk a little bit more about how you've managed some really neat collaborations and partnerships in terms of Apollo and those relationships.
Yeah, I mean, what we've done with Apollo is they basically leaned in and said, look, we see these three verticals the same way you see them. We see the lending and securitization market as $1 trillion opportunity. We see payments as $1 trillion opportunity. We see exchanges as $1 trillion opportunity. So their view is we've de-risked and have scaled lending, and obviously through Athene, we're doing stuff with them on the securitization front and so forth. What they're now looking at is, okay, how do we accelerate what we're doing on payments and exchange? So in exchange, for example, we're going to be listing an Apollo master fund for their new flagship alts vehicle. It'll be listed on the Provenance marketplace or Figures marketplace on Provenance. They'll do a primary raise and then provide secondary liquidity for it within that construct in a way that doesn't violate publicly traded partnership requirements or rules. And I think this is the beginning of a wave of listing on blockchain, leveraging blockchain cap table. And then obviously we're talking to them about migrating their companies onto this as well, to the extent that we can and as efficiently as possible for that benefit. And on the payment side, looking at where their companies are processing payments today, where they can leverage blockchain rails and USDF as a payment mechanism or vehicle. And I think making really interesting headway on both of those fronts. And what Apollo is now doing is saying, look, we want to lean in and bring other private equity firms, other large venture firms into the equation with you, with us. And so it's sort of a weird dynamic, because if you think, traditionally they fight for a deal because it's almost mutually exclusive, right? If Apollo's in, then Sixth Street's not going to be in, and if Apollo's in, Tiger's not in, whatever the case might be. And the reality is, the way they're looking at this construct is they're saying, no, you know what? We all benefit because Apollo owns hash and has a huge economic interest around hash, just like Figure does. We all benefit from ecosystem adoption. So we actually want to bring our peers in. We want to collaborate with them and kind of give them access to technology and access to the thought leadership happening around blockchain to really drive an ecosystem that we think is ultimately going to be ubiquitous and win.
But just to be clear, this isn't like elusive to anybody. Other people can also participate in this, right? This is completely, well, I shouldn't say completely, but this is regulated with a broker dealer.
Yeah, that's right. That's right. So within the exchange, there's a broker dealer that sits on top of it, which is Figures broker dealer. But the way that we do that or work with that broker dealer is we'll administer anyone's marketplace. And we charge de minimis economics to do that administration, so it's not prohibitive in that context. So the secondary transaction that happened in that limit order book, I think that was an 80% reduction in cost or expense versus a traditional private secondary marketplace, because of the efficiencies that we have, the lack of paper movement, the lack of some of the overhead. We definitely have a lot of pick and shovel infrastructure, to your point, around marketplace that we've invested with around KYC, AML, and accreditation and so forth. So but the key is Provenance is open source, is public, and anyone that wants to build on it can build on it. So what we're doing is we're giving technology to people to accelerate that build. And in some cases, it's turnkey technology. In some cases, it's SaaS technology. In some cases, it's source code people are taking and repurposing out. But we don't care as long as we're driving adoption and ubiquity. That's the end game for us.
Now, how did you get New York Community Bank to participate?
So, Tom Cangemi, the CEO there, or incoming CEO there, was very focused on evolving the bank and getting it to be technology forward. And they've done a couple of interesting things. They did the Flagstar transaction, which is a really interesting endeavor for them to add that consumer line into the bank, and obviously tons of intersection with what we're doing in mortgage and consumer as well. But we were really talking about the ecosystem and laying out the vision of what we felt could happen with USDF. And I think, he resonated right away, and he realized, look, the first movers here are going to earn a lot of rent. And I want to earn a lot of rent, because at some point when it's ubiquitous, I won't earn a lot of rent. And so if I'm going to lean in, I might as well get paid to do it. And so, took the leap and jumped in, and they've been a phenomenal partner to work with. Obviously, they're a bank, and so we have to move at the pace that the regulators will allow them to move. And it requires a lot of education and a lot of transparency, but excited that we got that first transaction off. There's a much larger transaction happening in early November, where NYCB is providing that marker. So a lot of momentum over there.
Mike, have you always been like an early adopter? And how is it that you've founded both SoFi and Figure?
Yeah. So I think that the general view is, there's so much broken in financial services, and when we did SoFi and we were thinking about what to do next, it was a venture capitalist I have a huge amount of respect for, who sat down with me and said, look, unless you can do $100 billion idea, don't do it. And I kind of laughed at him, because $100 billion, like I've never built a $100 billion company. I'm like, come on, there, like, how many $100 billion opportunities are there? And he said, just trust me, don't do it until you find one. And and then I started reading about blockchain, and I just had this, like, I didn't understand what it was for the longest time. The whole time I was at SoFi, I never understood what it was. And and I just thought it was Bitcoin. And when I actually got my arms around trust versus truth and bilateral transactions and the extension of that into everything, right? From my standpoint, it's going to disrupt everything. And there's reasons why it hasn't yet, but I think what firms like Figure are doing are basically groundbreaking the path to do it. And hopefully we're successful, and hopefully Provenance is becomes a dominant DeFi chain. But irrespective, we're at the cusp of what I think will be the most significant transformation of market cap from incumbent intermediaries into blockchain and the ecosystem built around that. And you're talking about trillions of dollars, not hundreds of billions of dollars. And the reason Ethereum is worth what it's worth, the DeFi ecosystem, if you take Bitcoin out of crypto, you've got $1.4 trillion of market cap. That's because if it really is able to disrupt what's out there, it's worth at least that, right? And that's why we're really excited about what we're doing, because again, it's not like there's a ready opportunity set where you can hop into something this big. Like, this is the biggest, most transformational opportunity set. It dwarfs whatever. With SoFi, we thought we could take on banking and transform the banking function, and I think the company's done a good job, and the current team there has done a good job facilitating that. But I think what we're really trying to do here is change the way everything works. And so it's just a much larger opportunity set, and it's a pretty unique period to be involved in blockchain.
Yeah. So when you start talking about saving the system 100 basis points in lending, with interest rates where they are today, it's just massive.
Well, if you think about a mortgage originator right now, they probably run about a 250 basis point gross margin and about a 0 basis point net margin. And so 50 to 100 basis points is life or death for them. and so it's and then it's 50 or 100 basis points or 120 against trillions of dollars, and so it adds up pretty quick. I mean, I think people ask me, well, why am I focused on lending for provenance? Because I think lending's easy 35 billion a year of gas fees that get paid into that blockchain to drive a lending ecosystem that still nets out, call it 70+ billion to the ecosystem for using it.
Now, something I think we touched on, but maybe we didn't drill deep enough. So transactions that go on your platform, it's not T+2.
Right. So and to clarify, like Figure runs marketplaces on provenance, but we don't own provenance, and anyone can build a T-instant marketplace on provenance. But all our trades are T-instant, and so so the equity that was sold, and I did a jab at DTC and ICE and Nasdaq on the last transaction and said, hey, we just traded private company stock at T-instant settle. Right, why are you still on T+2? And the DTC has this view that blockchain won't work because you need to pre-fund every transaction, and you do have to pre-fund every transaction to eliminate counterparty and settlement risk. Right, that's how the two sides face off, and you can effectively encumber the fiat and the asset and eliminate the settlement risk. But they operate under a false dichotomy because they're assuming that money's coming in through Fedwire, not through stablecoin, because stablecoin nets indefinitely. Right. And so once you introduce stablecoin into the equation, you get real-time netting versus end-of-day netting, which is what DTC does. And you effectively create a T-instant settlement system. DTC has got $50 billion of street capital it holds for settlement risk right now. All that goes back to the street. It charges a bunch of money for what it does. All that goes back to the street. But what's profound about this, and I think what people don't truly appreciate, especially in the exchange construct, is, blockchain exchanges, because they're bilateral, it's just you attaching your wallet to a decentralized exchange. There is no introducing broker, right? And so not only do you disintermediate NASDAQ, ICE, DTC, you disintermediate Schwab and Robinhood and Fidelity. Like, you don't need a broker anymore because you can hold it in your wallet. And then people say, well, how do you get credit? Well, lenders would love this because you get perfection to the security real time. And so you no longer have prime brokerage relationships. You go out and say, I'll lend you 50 cents on the dollar of Tesla stock. And that's what you're going to do. And I don't have to take your idiosyncratic risk when I do it. And so you actually create a much more egalitarian ecosystem for transactions where the security sit in my wallet. If I want to lend them, I'll lend them, right? If I want to hold them, I'll hold them. But there's no longer an introducing broker that's disintermediating me from the actual asset itself. And that level of disruption, I don't think people have really truly gotten their arms around yet.
Well, it's just happening before us right now, right? And what you're talking about is liquidity is real time, right? How's the system doing right now? You check on the hour.
Yeah. Well, and this is what's happened with crypto, which is, crypto has migrated from centralized exchanges to decentralized exchanges. And, there's a bunch of challenges with AMMs on decentralized exchanges, but still, that's where the volume's going. And that's, I would, if I'm in the securities industry, I would look at that as a bellwether as to what's going to happen, which is, people will just attach wallets to an exchange and trade. And there's no longer, an introducing concept, a settlement concept. So like, I would be thinking really hard. And sort of the irony is all these brokerage firms are like, well, should we allow people to trade crypto and, so forth? That's not the right thought process. The process should be, okay, like, what role do we play when there is no need for an introducing agent?
Yeah, it goes back to what you say, displacing trust with truth, right?
Right.
People are going to do what they're going to do. And in the way with trust and truth, if it's all transparent, people will figure it out.
Yeah. Well, I think you've already seen people gravitate towards the direct, disintermediated, decentralized exchange model on the crypto side. So I don't know why there'd be any expectations that people wouldn't do the same migration on the securities side.
So, Mike, looking beyond fintech, if you would, we always try and ask like two wild card questions. And one of the wild card questions that we ask is, what is the one thing that investors in the blockchain are not paying attention to today? You're the guy who's always ahead of the curve. Give us your views on what people should be paying attention to today that they're not.
Yeah, I mean, I think people are paying attention to this, but I don't think they've actually game planned what's going to happen if it happens. I think there's two huge externalities that are outside of any individual's control, and that's the regulators coming in and saying non-bank issue stablecoins illegal, and the SEC coming in and saying everything that you're doing is a security, right? And the ramifications of what that means, and I think there's absolutely conversations going on in Washington right now along the ideas of, if we declared stablecoin illegal, what would happen, right? Would we create chaos? Would it fizzle out? But I think those are two things that are potentially coming down the pipe in some form or another. And I think people need to really think through what that means on a second, third level basis, beyond the obvious of what happens when it happens immediately. And where do things migrate to, because they won't go away. And this is where, for example, in Figure's construct, and I'm not talking my own book, but I actually have a broker dealer that can run exchanges of any crypto asset that's now deemed a security, registered on chain. So there's ways that providers can step in and facilitate and move liquidity, but those are like the big existential things. And I think we've also been somewhat, maybe I don't know the right word I'm looking for, but everyone pushes this whole use case of title on chain, or of other things that exist in the analog world, and I want to put them on chain, and like the problem with title is even if title goes digital, there's no one who has a natural incentive to do that business, because what you're doing is intermediating a business that exists to nothing. And the analog stuff, and this is where I always poke fun at IBM, like tracking your strawberries on blockchain is dumb. And trying to put a Picasso on so I can own 10% of a Picasso when I have no idea if you actually even have the Picasso or sold it 20 times over, like that's dumb too. And it sort of goes against that whole original thesis of trust versus truth. They have an enormous amount of trust in those transactions. And when you need a lot of trust, the blockchain's not a good platform.
So should I assume that you're not a big fan of an ETF that holds Bitcoin?
I'm not a fan of an ETF that holds Bitcoin. I mean, I think it's fine that they have it. I just think Bitcoin's become so ubiquitous from an ownership standpoint. It's just, I think you're better off transacting directly. I'd feel better that ETF was also custodied on chain, and you had real-time visibility into the underlying holdings and the cap table, where then you don't have trust anymore, right? And the point of this is, like, think about what this does in the ecosystem. Well, you eliminate the need for a qualified custodian, you eliminate the need for a fund auditor. Like, there's all these intermediary roles because you have to trust the manager. But with blockchain, you shouldn't have to trust anybody if you do it right.
Yeah, I mean, the funny thing is, I guess, with that question about whether an ETF should be wrapped in, or whether a Bitcoin should be wrapped in an ETF, you're actually going backwards. You're not going forward.
That's right.
Because here we are today. You can do it all right on the blockchain. So beyond just finance, what other industries you think will be meaningfully impacted by the blockchain? Clearly, insurance is ripe.
Yeah, no, I think insurance is huge. I think identity is huge. Using a biometric to be part of your private key shard, so that I can authenticate on transactions, or on interface. I am who I say I am. I think within medicine, I think prescription usage to deal with script duping is huge. Like, there's some really interesting applications for an immutable trust versus truth platform. and that go way outside of financial services. I think that the issue is there's such fertile ground in financial services with such big dollars involved. It's like, well, yeah, I could use this to eliminate script duping, but I'm not sure that's the best initial application I'd want to run into as an entrepreneur. So, but yeah, I mean, like anything that's native digital, blockchain is going to have a significant impact too.
So what should I be worried about?
I mean, I think obviously, from a regulatory standpoint, there's a lot of uncertainties and externalities, as I said earlier, that we can't control. I think, and that's really the existential threat that everyone has is will someone come in and shut this down? Because it actually should be something that regulators embrace, because it's an open ledger, it's public, it's the people are always like, oh, you can use Bitcoin for nefarious purposes. Like, well, you can, but you can see exactly what wallets used it, and as was demonstrated in the whole ransomware attack with the utility company, they went and subpoenaed the wallet, got the private key, and took the Bitcoin back. Right. There was very little talk spoken about that part of it. Right. It was, oh, they used Bitcoin to pay the ransom. Well, yeah. And then they took the public ID of the wallet and got the money back. And, so it's actually a regulatory friendly construct. But, regulators can act irrationally, and, that's what I worry about more than anything else. I think you're also going to get the incumbents. If I was Visa and MasterCard, I'd be looking at this as, a real existential threat to, between the two of them, $850–900 billion of market cap. And what do you do? And I think what'll be really interesting is who is going to lean in and disrupt themselves, and who's going to just wait for the disruption to happen and ride it out as long as they can. And that's, we'll see how that plays out over the coming couple of years.
Yeah, that brings up maybe a last point. There's been some criticism of the speed with which Bitcoin processes. That's not the case for your system, your token, right?
Yeah, Provenance can do 10,000 transactions a second, no problem. And that's 10,000 transactions a second is peak load Visa holiday season, right? So, and I say no problem. You can stand it up way beyond that to the extent that you want to stand it up to do that. But it's like we're way past the technology proof of stake. We're way past the technology impediment. There's still, as I said, is a architecture impediment that's systemic to a lot of the chains, but it's not speed or cost. This is why Bitcoin was a phenomenal invention, and obviously it's become an incredibly effective store of value. It's never going to be a medium to do micropayment transactions through. Right. I mean, you're not going to go to your corner store and buy a Coke with Bitcoin, because you pay like $270 to buy your $2 Coke, and so it's just not going to work. But it is super cool from a technical standpoint, and from an architectural standpoint, and the application is store of value. But in terms of real transformation of the financial ecosystem. And a lot of people would disagree vehemently with me on this, but it's not Bitcoin that's going to be the platform to do that disruption.
No, who knows which one it will be, right? And that's our position. This is all an evolution, but not for the transaction. Bitcoin's not going to be that. I would agree with you. So, Mike, thanks so much for spending the time with me. Look forward to seeing your company grow. I meant to ask you at some point, how many people are under the Figure umbrella?
Yeah, so the Figure umbrella, excluding the mortgage company, is about call it 450 people, and then with the mortgage company, that's another 2,500. So across the board, close to 3,000, and obviously growing like crazy. So every day they give me new headcount numbers, and I say that it's a lot of overhead I got to pay for, but just means I gotta grow revenue faster than that expense base is growing.
It just means a lot of success. So thank you for your time. I look forward to talking to you further in the future, and be well.
Yeah, thanks for having me. I appreciate it.